Get started talking about Bollinger Bands. Now, in tonight's class, I prepared for you a couple presentations. Now, these little presentations are not re-recorded in the recorded version of this class. So if you want to see them again, you can go to YouTube and go to the channel called Forex and CFD Education. And then look for the playlist for Bollinger Bands. Now, in fact, if you look on your screen right now, you'll see some handouts. I've put together the essence of tonight's class in a very nice handout for you, the what's and how's of Bollinger Bands. So click on the download button, download it to your computer, and you can look at it after class. I've also given you the actual link to go directly to YouTube. And if you look under the file that I've given to you, under presentation YouTube link page, just go there and click on the link there, and you can go, you'll just go directly to the YouTube channel to see these and other short presentations. I've also given you, and this is something new I'm just trying. Okay, so hopefully it works all right. I've uploaded a little presentation, a little video on a great Bollinger Bands trading strategy. It's just a little PowerPoint, but I've uploaded it as a video to you. You should be able to click on that download button and download that video and watch it at your convenience. It's only a minute long, but it gives you a nice step-by-step strategy for using Bollinger Bands. And we're going to be looking at it in class, but this way you have it as a reference guide. I've also given you the introduction to technical analysis from investing.com and the technical indicators from investing.com ebooks. These are extensive ebooks. They make great reference material. You should have them in your trading library. Now you can download them, their PDF format, and use them and research with them and use them for any questions you might have. You'll have it right there at your fingertips. So please click on those download buttons and download those now. There's no registration, there's no nothing. Just click on the download buttons, they'll be on your computer, and you can use them at your convenience because they're only available in this live class. You can't download them during the recorded classes. Now, in tonight's class, I'm going to mix up the term security, asset. I might say Bitcoin, I might say Facebook, I might say the euro. But I'm just making it so it's not boring. So when we're talking about the euro, we're talking about all, or I say securities, or I say stocks. We're talking about all tradable financial assets that are available to trade in the open market. So it's anything and everything that you can trade in a CFD format. Okay. So whether I'm saying Facebook or Google, I'm just saying it because it gets very boring saying security, security, security over and over again. Same thing when I intermix the terms investing and trading. An investor, we know, is a much longer term position, and investors pay much less attention to any type of technical analysis, and they're more in terms of fundamental analysis because they're looking for long-term investments, where most of us here are traders, and especially Bollinger Bands work great for traders. But I mix up the term investing and trading only because it gets very boring otherwise. Now, it seems to be that every time I give a live class, you know, like a seminar at a conference, the first thing people ask me is, should I buy this today? Should I sell it today? What will the price be in an hour from now? Where will it be tomorrow, next week? Well, wouldn't investing or trading be easy if we knew the answers to these seemingly simple questions? But to tell you the truth, I don't have a crystal ball and I don't have a Ouija board. Anybody out there that tells you that they can tell you where an asset's going to be, tell you to buy the asset and sell it at this price and guarantee it's going to be there, is full of BS. Trading is all about filtering down and filtering out all the possible trades to come out with only high probability trades. And then the rest is applying risk management and knowing how to properly enter a trade and make the proper trade on your platform, how to have set your exit points, how to do stop losses, and how to monitor the trade. Because ultimately, whatever strategy we employ is only going to give us a buy opportunity or sell opportunity. And all the tools that we have after that help us filter out all the garbage trades and should end up with only high probability trades. So we're going to use technical analysis, whether we're using simple analysis like a trend line or we're using complex analysis like Bollinger Bands. We're using it as a tool, as a filter to filter out. First, we're looking for something to give us an alert to a buy or sell opportunity. Then we're looking to filter down and filter out most of the trades. And each step we go along and each filter we add should be filtering out more and more of these trades or supporting that trade. So that at the end of this little filtration process, we end up with the most high probability trades possible. Now, Bollinger Bands is one of the great tools that we can use. And one of the reasons that Bollinger Bands is so great, first of all, it's been around for a long time. Also, John Bollinger, who developed Bollinger Bands, is also still active. It's one of the few indicators that you can actually learn from the source, not listen to all these gurus and market analysts and all these people that are giving you this discretionary theory. You can actually go to www.bollingerbands.com and learn all about it directly from John Bollinger. Now, the fact is, Bollinger Bands are available as an indicator on almost every charting system you have out there. On Alvexa's platform, you simply on the charts go up to the indicators, click down, and click on Bollinger Bands, and it drops you right on to your charts. So it's very rare today to see a chart not accompanied by Bollinger Bands, as they become one of the most widely used visualization tools, which helps traders to see overbought and oversold areas of security. Now, Bollinger Bands falls in the category of bands or envelopes. It starts out with a center line, which is simply a moving average, and then it adds an upper and a lower band by using something known as standard deviation. Bollinger Bands can be applied in all financial markets, including equities, forex, commodities, and futures. Bollinger Bands can be used in most time frames, from very short term to hourly, daily, weekly, and monthly. So Bollinger Bands works very well for our type of trading because they adjust quickly and they will work in 5-minute charts and 10-minute charts. Okay. A lot of the indicators out there become less and less reliable in the shorter term time periods. And Bollinger Bands answers a very important question. Are prices high or low on a relative value basis? By definition, price is high at the upper band of the Bollinger Bands and price is low at the lower band. That bit of information is incredibly valuable. It is even more powerful if combined with other tools such as indicators for confirmation. So let's go over and look at Bollinger Bands on a live chart because we've talked about what these are, but you want to see them. So Bollinger Bands is one of the few indicators that's actually dropped on over top of price. Now, Bollinger Band starts out with a 20-period moving average. So I've already put the moving average on our chart here, and that's the gold line that we have going along the price chart. That's not a complicated scenario. You don't have to do any of this because if you click on Bollinger Bands, it just drops it on your chart for you. It then calculates 2 standard deviations above and below that moving average. And drops, these are referred to as the upper band and the lower band. And it drops these directly on your chart. And this is what a Bollinger Band looks like. Okay, you'll never have to do any calculations. You'll never have to do all these. I just separated so you can see the pieces of it. And so now we have the dark blue lines, the upper band and the lower band. Okay. These are two standard deviations from the moving average line in the center. Now, the shape of the Bollinger Band doesn't give us much information. We're not concerned with the shape. Sometimes they'll look like snakes. Sometimes they look like space aliens. Now, the width of the band tells us something about the market volatility. The narrower the band, the more contracted the market is. The wider the band, the more volatile it is. But we're more concerned with price interaction with the upper band and the lower band. And also price's relationship as it crosses over and above or below the moving average line within the bands. Okay. So Bollinger Bands falls in the category of what we call bands or trading envelopes. But now that you have it on your chart, you kind of got to figure out what to do with it. So let's pop back over to my PowerPoint. And first, let's talk about what this calculation is that we keep referring to as standard deviation. Now, it's quite complex, and you'll never in your life have to calculate it. But interesting, in the real world, no statistician would ever calculate standard deviation. Now, standard deviation was not developed for the financial markets. Standard deviation is a statistical formula that is used by statisticians for many purposes. Bollinger applied it to the financial markets and built his Bollinger Bands based on this statistical calculation called standard deviation. Now, standard deviation, and we're going to go through this one time. Like I said, you'll never ever have to calculate it, but you need to understand so you're not just sitting there blindly when somebody says, oh, well, Bollinger Bands is, based on two standard deviations. You're sitting there, okay, well, what's the standard deviation? Well, standard deviation is a measure of the dispersion of a set of data from its mean. Okay, well, that sentence says a lot, but doesn't really tell us anything unless you're a statistician. Now, first of all, we take the word mean and reuse it instead of mean, use moving average. So the standard deviation is a measure of the dispersion of a set of data from its moving average. If we change this dispersion of set of data, we can change it to standard deviation as a measure of price movement from its moving average. It is calculated as the square root of the variance by determining the variation between each data point or each price point relative to the moving average. If the data points are further from the moving average, there is a higher deviation within that set of data or that set of price movements. Now, in its simplest form, the mean is simply the average of all the data points in a given set. So if we've got a 20-period moving average, what are the data points? The 20 closes for the last closes. The data point is the close that we're measuring the moving average on. So it's using the 20 data points. In investing, for example, you might want to know the mean closing price for the last 20 days or the last 20 periods. Standard deviation is calculated based on the mean or the moving average. The distance of each data point from the moving average is squared, summed, and averaged to find its variance. So that's where it gets very mathematical. Or to put it another way, variance is derived by taking the average, the moving average, of the data point, subtracting the moving average from each data point individually, squaring each of these results, and then simply taking another moving average of the squares. Or standard deviation is simply the square root of the variance. So standard deviation is the variance of each close in relationship to that moving average. Okay, and then it's squared and summed and averaged out again. It's a very complex mathematical formula. So the base of the Bollinger Band is a 20-period moving average. The upper band is above the moving average by the volatility measure known as standard deviation. The default for Bollinger Bands is 2 standard deviations. Now, it's 2 standard deviations above and 2 standard deviations below. There's all types of people out there telling you to use 2.5 or telling you to use a 27 or a 32 period moving average. Well, the fact is, Bollinger developed using 2 standard deviations on a 20-period moving average. Now, if you go to Bollinger Band and listen to some of his lectures, he'll tell you that you can adjust it on your own, and you can, and it will create unique responses. But for you to use it for trading, you'd have to back test it, formulate it, make sure that it works, understand, because just saying, okay, I'm going to change this to 2.5 standard deviation, I'm going to change this to 30 days. Well, what is it doing to the outcome? Okay, what's it doing to your trading? Why is it reliable? Okay, most indicators you can adjust, but then they're no longer the indicators. So the literature, the research, and everything else that you read about isn't the result that you're getting by changing the outcome. So once you've got this indicator on your platform, you've dropped it on price. And one of the things I like about Bollinger Bands the best is since it is dropped over price, you're not ignoring price. Too many people get wrapped up in like RSI or MACD, and they're spending all their time looking at the bottom of the price chart and not looking at actual price. Bollinger Bands, since it's actually dropped on price, is the only thing that dictates anything you're going to do in actual trading is price. Period. The end. Price is the only ultimate decider of the markets. So Bollinger Bands gives us 3 ways to use them. They give us pattern recognition. Okay, they we've heard of head and shoulders, double tops, double bottoms. Well, Bollinger Bands has what we call W's and M's. And when it forms the W's and M's, which I'll show you in a minute, they give you trading signals. They also give you reversal signals to warn you when a market is reversing. And they also give you trend analysis. They detect trend continuations and conclusions. Now, if you want to subscribe to my belief, and I didn't come up with this idea, but I believe it and trade by it, that the markets are completely random. Price action is completely random. No matter what those big guys on Wall Street and those hedge funds tell you with their black boxes and all this kind of stuff, price is random. In this randomness of price, there are certain times of non-random movement. If you can find these periods of non-random movement, you can then apply trading indicators and make smart trades. These non-random movements are uptrends and downtrends. But these are times when you find a very defined real trend, not a look of price moving up, but a defined real trend up or down, that all of a sudden price is moving in a non-random fashion. Okay. In these small periods of time, you can then interpret the market and make smart trading decisions. So you want something that's going to help you see and prepare for these non-random periods. And you also, when you're in those non-random periods, you also want something to warn you when the randomness is coming back. Or, in other words, the trend is ending or concluding. Now, finding, like I said, finding a price, an entry point, getting an alert that you get a buy or a sell opportunity, okay, the first thing you want to do is say, okay, is the market trending? If it's not trending, you've now filtered out that trade and thrown it out the door. If the market's trending, then you're going to move to your next step and next step. Because when it's trending, you're in those periods of non-random movement that you can then decipher. Now, with Bollinger Bands, like I said, the first thing it gives us is pattern recognition. Now, these are slow to develop. It's not complex like triangle. It follows the same thing as you see triangles on charts, head and shoulders on charts, and it develops as slow as a head and shoulders. It's not something you'll notice when it's forming. It's something that you'll notice when it is actually almost finished its form. And these are called W's and M's. You won't even notice it happening as it forms the W. The W forms when price moves into a downtrend and hits a bottom within the band, bounces off of that bottom, tries to reach the top of the band, bounces off, and comes back down to form the second bottom. This is called the N formation. When this N has been completed, that's when you should notice it happening. Because up until that point, it's just price movement. When you've got the bounce off the second bottom, and this N has now started to form into the W, okay, once it bounces off and it's forming this last leg of the W, you can now make some sensible decisions. When price has bounced off the second bottom and is forming the last leg of the W, if and when it crosses the moving average, that generates a buy signal for you. And you can determine your entry point and your target level and also set your stop loss. You would set your stop loss at the bottom of the N formation. You would set your take profit point equal to where it started to form the first leg of the W. And you could then use all of this to form a trading decision. You have the exact opposite in the M formation, which comes off of the downtrend or sideways movement and makes the uptrend. And makes the first top, comes back down, forms the second leg, bounces off there to form the second top. And it's at this point that you might notice it. Again, until it bounces off and breaks that moving average line, it's really told you nothing. Once it does that, you then can set your parameters. So a bearish top pattern is formed by two successive tops in price, which opposite of the W formation form the M. Before forming the entire M, an N will emerge in the price action, and this is the point at which traders should get prepared to be involved. Now, this works extremely well by combining it with RSI. RSI and Bollinger Bands makes a perfect match. Now, the other thing we want to look for are trend reversals and continuations. And this becomes part of recognizing what's going on within the Bollinger Band. So let's go back over to the chart. And what we want to do is, again, we're not concerned with the width of the band. What we're concerned with is the relationship of price to the upper and the lower band. And we're less concerned with the tails or the wicks of the candles and concerned with the closes. So here what we can see is price pushed up to the moving average, fell back down below, and then finally broke above. But when price moved up to the upper band, price closed at that upper band twice, but was unable to sustain and fell back down and moved into a mess of sideways congestion. There was no trading opportunity here. But earlier, we saw price riding down this band. When we see price riding down that band, that staying below the moving average, when it fell below the moving average, started riding the lower band, that tells us we're in a downtrend. We could have traded that asset going all the way down, and we would have exited the market when the close first closed outside the lower band. If we were looking to enter the market, we're looking for the price to pop back up. See, again here, we see lots of lows violating the lower band, but we don't see it closing much lower. At this point, we're out. Okay. But we want to see the relationship of the bands with the upper and the lower band. This is what we call riding the bands here. And we can also use the upper and the lower prices to set our entry points, our exit points, and our stop loss points. So during trends, the moving average holds very accurately, and a break of that moving average is usually a meaningful signal that the sentiment has shifted. Okay, so we're going to take a look at the screenshot in a second, and we're going to be able to see or interpret the entire history. The moving average can be used as a trade exit signal where a trader does not close his existing positions unless price has broken the moving average. By combining Bollinger Bands with the moving average, a trader can create a robust trading method. So let me share with you a little presentation on Bollinger Bands that may explain this a little bit better in a visual presentation that I'm showing you right now. So
to the live market and take a look at the pound dollar on a daily chart to illustrate how we can trade using Bollinger Bands. The upper and lower bands represent two standard deviations away from the market, and the middle band is based on a simple moving average. There are many combinations that one can use in terms of the Bollinger Bands settings. However, the default and most common settings used are a period of 20 with a deviation of 2. Bollinger Bands can be used in ranging or choppy markets, that is, during times of consolidation like here, and also in trending markets. Therefore, this tool can be used by scalpers, day traders, and even long-term traders. Let's firstly take a look at how we can trade these bands in tight ranging conditions. As you can see, the market is ranging at this highlighted section. Note that price bounced between the upper and lower bands whilst it is ranging. Note that in this example, the range is small, therefore opportunities arise for both longs and shorts to be undertaken. A strategy can simply be followed by taking a short at this point. Once the price hits the upper band, placing a stop loss above the upper band here, and a profit target may be placed at the bottom band here. Once the lower band has been hit, the sell trade is closed. However, an opportunity to go long or buy arises. A buy can be executed here with a stop loss below the lower band and a profit target set at the point where the price hits the upper band. As you can see from these examples here, there were multiple trades to take both long and short. Another way to trade with Bollinger Bands is to focus on contraction and expansion. In simple terms, when the market ranges in a tight area or consolidates, it's known as contraction. Generally, what occurs in trading is when the market contracts like this, a breakout tends to follow. This is known as an expansion in the market. As you can see, the market had contracted here, then dynamically expanded to the upside, creating an uptrend. Traders can employ this strategy when trading with these bands. Traders can enter a long position once the market has broken out of the range at this point, highlighting a potential move higher. Using various tools to execute the buy once they have recognized at a point that the trade might trade higher can help determine the entry. Basic tools such as previous support as leverage or even trend line breaks can help to determine the buy. A stop to be placed below the entry at a point of tolerance, and a profit target measured by the range of the contracted area or potentially a break back below the middle band. Let's take a look at a short example. This is the ranging zone with potential for trades within the contracting period. Once the price clearly breaks out and expands to the downside, a sell can be executed, here, for example, or even here. Once the direction has been determined, in this case, to trade a sell or to go short, the entry and exit points must be managed applying a sound risk management ratio. This expansion strategy can be traded on many time frames. Let's take a look at another strategy designed to use Bollinger Bands. One of the most difficult aspects of trading is to determine the trend. In this case, we will use a certain technique with the bands to help us determine the trend. Firstly, this setup requires patience and discipline, as the bands will tell us which way we are trading, either long or short. Using candlesticks for this technique is preferred, as you can see the closing price better than any other type of chart. An understanding of price support and resistance is critical for the entry, so please visit the support and resistance modules if you haven't done so already. Let's start with buys or longs. Step 1. We need the candle to clearly close above the upper Bollinger Band line. For instance, like here. The closing price has closed above the upper band line. Please note here, if you look closely, the closing price of these candles have not closed above the upper band. Only their wicks have gone above the band, but the actual candles have closed below the upper band. So this occurring is critical, as the part of the first criteria of the trade has been met. Once we clearly see that the green candle has closed above the upper band, we must ensure that when this occurred, that a new high was also generated. For example, when the candle closed above the upper band, we also had price generate a new high. This is critical, as this part of the setup defines the direction of the trade, and that is to go long once these two elements of the trade have been met. Just to repeat that step one more time. Once the candle closes above the upper band, we must ensure that in the process a new high has also been generated. Step 2 is to look for a specific entry point, so we know when to buy. This is where previous price highs and lows come into play, as these are the points we need to use as reference to execute the order. When step 1 has been confirmed here, we need to wait for the market to retrace back to a previous high. Find a relevant high to use, then execute the buy order. For example, here. Price has acted as a magnet and retraced back to these previous price highs, paused, and continued to move higher in the uptrend. A stop loss can be tight below the previous high levels, and new highs can be targeted in terms of a profit point. Let's take a look at a sell or short trade. Let's highlight the candle that closed below the lower band, here in this example. As you can see, the market is trending down, and this red candle has closed well below the lower band. Furthermore, a new low has also been established, as you can see when we compare this low to the previous low. Once this part of the trade criteria has been met, we understand we are looking for an entry point to go short. We need to look for previous lows to act as resistance to define the entry. As you can see, we will use this low here, and once the price retraces back to this point, a sell order can be taken. A stop loss is placed back above the entry at a point of tolerance, for example, just here, and a profit target to be placed at new lows. With this technique,
So as you can see, the Bollinger Bands are an exceptionally helpful in determining when an asset is overshot to the upside or the downside. It's important to use the bands also to set risk conditions, not just entry points. Additionally, risk and reward should be set based on the width of the bands or volatility, with narrower risk-reward ratios being used in low volatility and wider risk-reward ratios used during high volatility. Now, in contrast to most other indicators, the Bollinger Bands are non-static indicators, and they change their shape based on recent price action and accurately measure momentum and volatility. Thus, we can use the Bollinger Bands to analyze the strength of trends and get a lot of important information this way. So we want to pay attention to a couple things. During strong trends, price should stay close to the outer band. If price pulls away from that outer band as the trend continues, it shows fading momentum. Repeated pushes into the outer band that don't actually reach the band show a lack of power. A break of the moving average is often the signal that the trend is ending. Now, I've got a little presentation I'm going to share with you that's going to show you a little simple strategy how to incorporate Bollinger Bands. And I've also given you this in that download handout that I gave you, and it's called a Great Bollinger Bands Trading Strategy. It's only a few minutes long. It doesn't have any narration. Everything's written on the slides for you. So watch the video and watch it, and then you can, if you click on the download button, download it. You can watch it at your convenience whenever is convenient for you. But it's just a short, sweet, easy strategy, different than the other one, to show you another way to use you can see that's another way, a simple way to incorporate Bollinger Bands. Now, a very good way to, okay, one of the best indicators to use with Bollinger Bands is RSI. But you can combine Bollinger Bands with like MACD and RSI and use it for confluence. And I'm going to show you how to do that right now. And we're going to show you how to apply RSI Then we're going to show you how to use MACD and then Bollinger Band, and then we're going to combine them together into one easy to use trading strategy.
Indicator 1, RSI. The Relative Strength Index compares the magnitude of recent gains to recent losses in an attempt to determine overbought and oversold conditions of an instrument. As you can see from the chart, the RSI ranges from 0 to 100. An instrument is deemed to be overbought once the RSI approaches the 70 level, meaning that it may be getting overvalued and is a good candidate for a pullback or reversal. Likewise, if the RSI approaches 30, it is an indication that the instrument may be getting oversold and therefore likely to reverse. Traders will often use the RSI either coming back out of its overbought or oversold areas as a signal or partial signal to enter a trade. As we can see, the RSI is often accurate when indicating when a market will reverse. A trader using RSI should be aware that large rallies and drops in the price of an instrument will affect the RSI by potentially creating false buy or sell signals. Traders often combine the RSI with other indicator signals, such as MACD crosses. Indicator 2, MACD. The moving average convergence divergence is one of the most well-known and used indicators in technical analysis. This indicator is made up of two exponential moving averages which help measure momentum in an instrument. These moving averages and the changing distances between them become the MACD. Convergence simply means the moving averages are moving closer together, and divergence simply means they are moving away from one another. When the shorter term moving average is above the longer term moving average, this area of the indicator will show activity. When the shorter term moving average is below the longer term moving average, this area of the indicator will show activity. The center line, of which the MACD is plotted around, indicates where the moving averages are equal, and when the MACD passes through the center line, this indicates the moving average is crossing. The signal line, here in red, is a moving average of the MACD values themselves. Typical values for the MACD are 26 and 12 exponential moving averages and 9 for the signal line. The farther apart the moving average is, and the greater the momentum, the farther away the MACD will be from the center line. Traders use MACD and signal line crosses, such as these, to indicate momentum trades. You can see how these crosses often match up with market moves. Traders also use the MACD crosses to indicate when momentum is coming out of the market and may use it as a signal to exit a trade. Indicator 3, Bollinger Bands. A Bollinger Band starts off with a simple moving average. It then has two standard deviations plotted away from it. That sounds a mouthful, but the important part is because standard deviation is a measure of volatility, Bollinger Bands adjust themselves to current market conditions. When the markets become more volatile, the bands widen, move further away from the average, and during less volatile periods, the bands contract, moving closer to the average. The tightening of the bands is often used by technical traders as an early indication that volatility is about to rapidly increase, as volatility often follows periods of lack of volatility. The markets spend most of their time within the bands, and when the price action reaches the edge of the bands, it is often more likely to reverse and come back into the range. This is used as a signal by reversal traders to take a trade. This is similar to the oversold and overbought conditions of the RSI. Indicator 4, Super Trend Indicator. The Super Trend Indicator is an excellent indicator of trend direction. It can be used as a foundation of a trading system that is based on trend following. One of the most popular ways to use this indicator is to enter the market after a pullback. For example, if the market is on a downtrend, indicated by red, wait for a green pullback and then re-enter the market once it turns red again. The same can apply in uptrending markets. Here we can see how this indicator accurately tracks market trends. It can be refined through the settings to match the specific instrument. Indicator 5, Confluence. The last indicator isn't a new one, it's indicator confluence, which means to use multiple indicators and their signals to take a trade. Here we have the RSI and MACD we looked at. We have the RSI moving into overbought territory here. Remember that indicates the market will reverse. However, we want to help us filter out false signals on the RSI, so we also look at the MACD to give us confluence. We can see it is indicating the momentum has come out of the market, as far as the market rallying or going up is concerned, and we have an MACD cross here. A signal to enter this short trade could be waiting for the RSI to come back out of the overbought and also waiting for the MACD cross. We can see that those combined signals are an indication that captures this trend. You can also use the opposite signals to indicate when the momentum is coming out of the market and it's more likely to reverse and the market to retrace back up the opposite direction of our trade, and therefore is an exit signal. In addition to the RSI and MACD signals, we can add further confluence to this trade with a Bollinger Band and the super trend indicator. We can see the market has hit the top of the Bollinger Band here, but we could also wait for the super trend indicator to change red here before taking the short trade. So now we have the confluence of four indications. We have an RSI coming back out of overbought, we have an MACD cross, we have the market going to the edge of one of the deviations on the Bollinger Band, and we also have the super trend turning back to red.
So there is a preciseness here of using Bollinger Bands in this way. Use the preciseness to your advantage. There are literally hundreds of potential variations to use. Now, another well-known strategy using Bollinger Band is called the Bollinger Band squeeze. And it's a very, very simplistic strategy, but can be quite useful and reliable. First, we want to look for a security with a narrowing band with low bandwidth. That's the band starts to contract and come together. Okay. The bandwidth should be near the lowest end of its recent trading range. So we want to look for when the market has gotten very contrite and that band has gotten very, very narrow. Then we want to wait for a band break to signal the start of a new move. An upside band break is bullish, while a downside band break is bearish. Note that the narrowing bands do not provide any directional clues. They simply infer that the volatility is contracting, and charters should be prepared for a volatility expansion, which means a directional move. So as the bands narrow, we will wait for them for the asset to break above or below that band, and then we would look for a trade in the position of that breakout. So in other words, we want to keep our eyes on the band. So even though the Bollinger Band squeeze is straightforward, charters should at least combine the strategy with basic chart analysis to confirm signals. For example, a break above resistance can be used to confirm a break above the upper band. Similarly, a break below support can be used to confirm a break below the lower band. Unconfirmed band breaks are subject to failure. Now, because the Bollinger Band squeeze does not provide any directional clues, charters must use other aspects of technical analysis. So that's why we looked at combining Bollinger Bands with the other indicators. So you can see that the Bollinger Bands are a multifaceted trading indicator that can provide you with lots of information about trends, buy and sell balances, and other potential trend shifts. Together with the moving average and RSI, Bollinger Bands make for a great foundation for a trading strategy. So thank you very much. We're going to wrap up this class. Again, if you have any questions, go to www.alvexo.com, click on their Education Center, and you'll find all the information you need about Bollinger Bands there. Or you can send them an email or use their chat with us, and a technical analyst or financial analyst will be glad to chat with you and help answer your questions. So thank you very much for joining us tonight. Please make sure you click on those download buttons to download those handouts. The what and hows of Bollinger Bands will explain all the strategies we've looked at tonight. So make sure you get them and use them as your reference guides to adding Bollinger Bands to your trading. And again, if you have any questions, contact Alvexo, www.alvexo.com. Have a great night, and thank you for supporting investing.com. Good night now.